Business Value Podcast. This podcast is brought to you by Mastery Partners, where our mission is to equip business owners to maximize business value so they can transition their business on their terms. Our mission was born from the lessons we've learned from over 100 business transactions, which fuels our desire to share our experiences and wisdom so you can succeed. Now here's your host, CEO of Mastery Partners, Tom Bronson.
Hi, this is Tom Bronson, and welcome to Maximize Business Value, a podcast for business owners who are passionate about building long-term sustainable value in their businesses. In this episode, I'd like to welcome our guest, Bharat Kanodia. He is principal at Veristrat, a valuation firm based in San Francisco. I met Bharat through Provisors, a professional networking organization with local groups throughout the U.S. But after talking with Bharat, I visited his YouTube channel, What's It Worth? Worth a stop for you, for sure. And I fell in love with his process and his down-to-earth delivery style. I'm sure you're going to love his YouTube channel. So as we've discussed many, many times on this podcast, one of the biggest obstacles to a successful business exit is unrealistic owner expectations regarding the value of their business. So today, we're going to talk about how to value a business with a leading valuation expert. Welcome to Maximize Business Value, Bharat. How are you today?
How you doing, Tom? Thanks for having me.
So glad to have you with us. Tell us a little bit about Veristrat and maybe your YouTube channel.
You love indulging people, don't you?
I do.
So thanks again. We're a valuation and advisory firm, and we help venture capital, private equity, private businesses, founders and entrepreneurs who are looking to raise capital. We help them understand valuations. Valuations over the last 10 to 15 years have gotten a lot of PR. Because every day you hear that, oh, this company raised $100 million at $4 billion in valuation, and this company is worth so and so. And what I am doing with Veristrat and my YouTube channel is I am lifting the veil. I am explaining in very, very simple terms to people how valuations work and how you can take advantage of some of the things on which valuations depend on.
I love that because it's just one of those things that is a mystery to most business owners. They can't really articulate it, but they have a value in mind. So what is your background and why did you start the business in 2010?
You know, a young kid growing up in New Delhi, India, I would look at the stars and I would dream about coming to America one day and becoming an appraiser. No, that.
Yeah, that's every kid. Yeah, I wanted to be a fireman, and you wanted to be a appraiser. I get
it. No.
I can already tell this is going to be more fun than I'd bargained for.
I went to college in Madison, Wisconsin, UW-Madison, for engineering, and I hated it. I hated it to my core. What are you going to do? You're going to get out of Madison, drop out? No, that's not an option. So you just power through and you graduate. But once I graduated, I was off my father's payroll. So now finally I could do whatever I wanted to do. So I wanted a job in finance, but who's going to give a 21-year-old kid with an engineering background a job in finance? Well, I found one guy who I could talk into giving me a job in finance, my ex-boss. So they were looking for one engineer on staff, and after he interviewed me, he said, all right, you're it. So I was one of the few engineers on staff at a company called American Appraisal, which at that time was the largest and the oldest valuation firm in the world. In fact, American Appraisal had invented the valuation business. There was no other valuation firm before that firm. So I got to work at that firm. Now that firm is acquired by Duff and Phelps, but I got to work with some of the original appraisers. These guys, they invented the business as we speak at that time, um, which was great. And my boss loved me. So I got good opportunities to advance my career. I started out doing simple, tangible assets like machinery and equipment. And, they liked my work there. They said, okay, now you can do real estate. So I started doing real estate valuations. Then they liked my work there. Then they moved me on to doing infrastructure valuations, where I'm appraising like airports and stadiums and pipelines. They liked my work there, and then they graduated me to doing companies. So it sort of spiraled up, if you will, from my first job in 2000.
Wow. So you mentioned this when we talked last week, that you actually have appraised airports and pipelines. That just sounds fascinating to me. And I think you also mentioned that you appraise bridges, right? So
Yeah.
so I guess if you can appraise almost anything, right?
It, it, and it is kind of funny when somebody says, why would you need to appraise a bridge, or why would you need to appraise an airport? Well, there are valuations or appraisals, if you will, right? Let's use those terms interchangeably for this conversation, right? Technically they're separate, but for conversation, let's say the same. Um, Valuations are used for four purposes, right? The traditional purposes that we know of is some kind of a deal or transaction. Somebody's trying to buy a business or sell a business or buy a share or sell a share. Or it could be done for insurance. You need a valuation of your house for insurance. Similarly, they need a valuation of a bridge or an airport or a hotel for insurance. They need valuations for accounting. So, say if somebody invests $100 in a company, they need to show on their books what that $100 is worth in 6 months, in a year, or 5 years. And the fourth type of valuation that most people need is for tax purposes. Could be gift or estate or some kind of way where Uncle Sam can say that, hey, this is my cut.
Perfect. Perfect. So it's safe to say that you've got a broad experience in valuing all kinds of interesting things, including businesses, of course. So let's jump in. Uh, why is it so important for business owners to really understand the value of their business?
Great question. And I've been harping on this for years, and most business owners, and I'm a business owner, and outside of the valuation business, I have other ventures. So I speak as a valuation expert and as a business owner. Most business owners, including myself, we do not think of getting a valuation until there is a need, unless somebody says that you need to get a valuation. Whereas as a business owner, I now think that all business owners should get a valuation at least once a year. Similar to, why do you go to a doctor for a yearly checkup? Similar to, why do you have an exam at the end of the semester or end of the year, just to sort of, it's a scorecard. It helps you understand where are you in terms of growth, in terms of benchmarking to others or benchmarking to your competition. And valuation as an exercise, I mean, can be very expensive. But if you want to do just a scorecard type evaluation, just to understand that, hey, this year, yeah, we're putting, everybody's putting in 80 hours a week, but did we add value to the company? And that is something a simple valuation can tell you.
I like that. Having a simple valuation, sort of thinking about it like a scorecard. I think that's brilliant. I'm a big fan of keeping score, right? Thinking about KPIs and things like that. Your valuation could be one of your key performance indicators that you get on an annual basis. Um, you know, I'm gonna run the risk here of bursting your bubble and making you hang up on me, but I have. It's hard to value businesses. I get that, and I appreciate what you do, but I have the simple formula for valuing any business on the planet. I can establish exactly what it's worth. And you want to know what my formula is? Finding a willing buyer and a willing seller who agree on the price. There you go. See, I just eliminated all the stuff, the hard stuff that you do, but it's so important for a business owner to have a realistic expectation. Most business owners don't give a lot of thought to what their business is worth. And then therefore they create in their mind some valuation that is perhaps unrealistic, and really not based on anything other than what they might think it's worth, or some anecdote of a friend who recently sold a business, or you heard a valuation on another business completely unrelated to theirs. But if you've really got a clear understanding of what your business is worth, then you can focus on building that value to get to the point that you can exit that business in a way that you want. So I'm a huge fan. I love the whole scorecard, and getting that on a regular basis, and doing it more as a thumbnail exercise as opposed to anything else. So I think it's important that we explore a little bit here of what buyers are looking for in a target, and how that relates to value. So Bharat, I know you work with a lot of buyers. I know you work with private equity and investment bankers. What do buyers look for in a target?
Oh, it's very easy. I mean, business is really easy, Tom. It's just we make it very complicated. Business is very straightforward. Buyers are looking for two things, two and only two things, and rest, in my humble opinion, and people pay me for my opinion, is BS. Buyers look for consistent cash flow. Number one, buyers want consistent cash flow. Number two, buyers don't want to do anything to enjoy that cash flow. That's it. Two things. So if you have a business that gives consistent cash flow, and a buyer or the owner can sit on his butt and enjoy that cash flow, that business is worth a lot of money.
I love that. But of course, you boil it down to two simple things, and it is complicated underneath that, and you know that as well as I do. But I like those 2 points. That's why one of the things that we discuss with our clients all the time is got to have clear, duplicatable processes, right? So that if something happens to the owner or a key employee, that you've already got a step-by-step, paint-by-numbers process for how that works. And so being able to get that consistent cash flow is so very important. And the way I have always kind of looked at what a buyer is looking for, it is that long-term predictable cash flow. And if you have kind of a hockey stick or a roller coaster approach to your cash flow, then a buyer is going to have a hard time believing that. And so I agree. I think I've decided now, instead of having the 500 points that we look at in a business, I'm only going to look at these two things, and I think it's a brilliant strategy. So if it is those two things, how can sellers prepare for an exit?
Great. So consistent cash flow and autopilot. So how can one get consistent cash flow? So recently I was appraising a CPA firm, and the CPAs, that firm, they also do some strategic advisory type of work, right? Nowadays, if you add the word strategy in front of anything, it's sexier, it's cooler, right? So they do advisory work as well, but the advisory work is fairly ad hoc. If it comes in, it comes in. They're making $80,000 for a month's of work, and if it doesn't come in, come in. It's ad hoc. But the tax and the audit piece and the assurance piece, that is a recurring revenue. So, they were like, okay, so we have this much work that's recurring revenue and this much work, which was about 30% of the chunk. They said, this is ad hoc. I said, okay, well, your ad hoc, take that off the shelf. That's worth nothing. And they were angry at me. They're like, what do you mean it's worth nothing? I'm like, okay, can you guarantee that we'll get this work next year? No. Can you guarantee it's going to be higher than this? No. Can you guarantee it's going to be 20% lower than this? No. I'm like, well, then it's worth nothing. I'm glad you bought your Mercedes, but the buyer's not going to care. So consistent cash flow, you can develop consistent cash flow by a few things. The most important thing with consistent cash flow is customer loyalty. Now, you could call it loyalty, or you could call it, customer membership, or, whatever you want to call it. There's a reason why Costco sells you the $75 membership. $75 doesn't matter, but it gets people to buy in. That's the customer loyalty. The airlines are giving you miles. They're not stupid. The miles are sitting as a liability on United or Delta or all these airlines. They don't want it there, but that is the cost of gaining customer loyalty. If you buy Zoom subscription today, right? If you buy Zoom, I think it's like $15 a month, I think, if you pay on a monthly basis. But if you pay for the year up front, instead of $180, it's $150. Why are they giving you a 20% discount? Customer loyalty. Wall Street rewards the $150 for Zoom far more than the $180, because now you got the customer for the year.
Right. So having that kind of long-term relationship, and of course, the beauty of doing that by signing an annual subscription. The theory, of course, on the company side is that you're going to use that and become dependent on it. When it comes time to renew next year, there is a very high likelihood that you're going to renew, and buyers know that. Am I kind of going down the right path?
Oh, absolutely. If somebody told me that, look, I've got two customers, one is going to pay me $1 million up front and one is going to pay me $100,000 per month, guess which one I'll tell them to take? I'll tell them to take the monthly paying customer, because you're going to have to service the $1 million customer too, which you don't have the capacity to do. So I'd rather take the $100,000 a month customer and build your process in a way that you can service that customer.
Yeah, and not that I want to get into an accounting conversation, but I was recently with a prospective client that they got a 3-year agreement, basically a prepaid 3-year agreement. And I was asking questions. I said, what is this big lumpy thing that happened in, let's call it April this year? Why did suddenly your revenue triple that 1 month and then it's back down to where it was? He goes, oh, well, we signed a 3-year agreement with a client and got paid up front. And I said, and all of that hit your financials now? And he said, yes. And I said, well, that's not the appropriate way to do that. That should have gone to your balance sheet and you relieve it over time, because then you relieve it when the service is delivered. A year from now, by the way, that's a liability, right? And a year from now, if you sell this business, you're going to have to pay that chunk that's still remaining on that to the buyers so that they can fulfill that. So a lot of times people don't really get the advice of their financial advisors, and when you're evaluating a business, that's the kind of thing that you would catch in there, because you'd ask the same question. Gee, why did suddenly we have this balloon month and nothing beyond there? So I love that. Consistent recurring revenue is a big theme for us. And so by the way, before we take the break, I didn't even give you a chance to respond. What did you think of my valuation formula?
I love it. I really do. And I'll tell you why, because it resonates with me. One time I was working on a litigation job, and both sides had hired us jointly, the buyer and the seller, and they were both, angry, pissed off at each other. So let's just say, for argument purposes, one said the value is 20 million and one says the value is 30 million, and I'm the schmuck in the middle who's trying to decide, okay, what's what. And I was just a kid, right? So, and I feel like, oh, my first litigation case, what am I going to do? And a lot of depends on, this is not funny money, right? This is like real money. These are affecting people's pockets and bank accounts and legacy and retirement and inheritance and all that, right? So I was a little stressed, if you will. Maybe I was taking it a little too seriously. So I went to my boss. I'm like, hey, what am I supposed to do here? Is like, I frankly can justify 20 million and I can justify 30 million. What am I to do? I mean, I'm an appraiser, right? I know what assumptions I need to tweak to get here or to get here. And I can talk myself into both. And my boss says, Bharat, you're not understanding your job. I'm like, what? He's like, you're not understanding why you're hired. I'm like, okay, you tell me then. He's like, your job is to piss them off equally. I'm like, oh, okay. So it was just an eye opener for a young kid. So yeah, I agree. It's the willing buyer, willing seller, somewhere in the middle.
Yep, that's exactly right. So we've got to take a break. We are talking with Bharat Kanodia. Let's take a quick break. We'll be back in 30 seconds.
Every business will eventually transition, some internally to employees and managers, and some externally to third-party buyers. Mastery Partners equips business owners to maximize business value so they can transition their businesses on their terms using our 4-step process. We start with a snapshot of where your business is today. Then we help you understand where you want to be and design a custom strategy to get you there. Next, we help you execute that strategy with the assistance of our amazing resource network. And ultimately, you'll be able to transition your business on your terms. What are you waiting for? More time? More revenue? If you want to maximize your business value, it takes time. Now is that time. Get started today by checking us out at www.masterypartners.com or email us at info@masterypartners.com to learn more.
We're back with Bharat Kanodia, principal at Veristrat, a valuation firm based in San Francisco. We're talking about business value. So, Bharat, before the break, we talked a little about preparing a business to exit. What are some of your go-to levers to maximize business value?
Again, going back to basics. So I would be looking for consistent cash flow and consistent cash flow that runs on autopilot. Okay. So consistent cash flow, what would get me a consistent cash flow? Some kind of a customer loyalty referral appreciation program, right? If they have that in the mix, if not, that is something they need to start working on. Secondly, making things run on autopilot. This is where the processes and the people and the procedures, they come in. And when I'm talking about processes and policies, I'm not talking about 50-page documents or 100-page documents which you put together and then nobody reads. It sits in the back somewhere. I'm talking about investing in technology. Technology nowadays, Tom, as you know, is cheap now, right? $10 $10 a month, $50 a month, $100 a month. You can get technology that can, you can run a 5-person firm that does work equivalent of a 200-person firm if you have the right technology backing it. And when I say technology, I don't mean custom technology. I just mean the technology platforms that are just out there for us to use on a subscription basis. That is really always my advice to entrepreneurs when they say that, hey, where do I invest? I said, invest in technology. You'll never go wrong.
So are those kind of the things, do you actually peel back the onion when you're doing a valuation and actually consider things like that in the valuation?
I will look at how close this business is to being run on autopilot. If the owner is saying that no, I got to write the proposal, or I got to call this guy, or I need to be doing this, that is not telling me a very good story. Because when you're then trying to sell the business, you're not selling a business, you're selling a job. No investor wants to buy a job, they're looking to buy a business.
Right. In fact, I always say that now, I know in your business there are reasons or kind of deductions that you would take for owner dependency, but in very small businesses, my opinion is that a business that is 100% dependent on the owner is almost worth zero. It might not be worth exactly zero, but it's almost worth zero because if something happens to the owner, the business is going to fall apart if it is dependent on there. So I'm glad that you take a look at those things. So what sets your business apart from other business appraisers?
I am a different kind of appraiser, Tom. Most people in my world, they silo themselves into doing one type of evaluation or one type of an asset. So somebody might say, hey, I only appraise wineries, or I only appraise ESOPs, or I only do insurance work. Um, as I had told you about my experience working for American Appraisal, and I had good bosses, and they sort of let me sort of run with things. So I'm one of the few appraisers who can value tangible assets like a power plant or a copper mine or a stadium, to the other side of the spectrum, intangible assets like a copyright or a domain name or a patent, or things in the middle like entire businesses or different classes of stock within the business like the options or the RSUs or what have you. And in different industries, I mean, I have appraised bridges to airports to technology companies to your local repair shops. So think of me as internal medicine or a physician.
I love it. I love it. So, one last business question, Bharat. This podcast is about maximizing business value. What is the one most important thing that you would recommend to any business owner in order to build long term sustainable value in their business?
Um, Always think of your business from a buyer's perspective. So if you were to vanish from this planet tomorrow, can the buyer run your business without you? And if you think he or she can't, that's not a good sign. If they need you to run the business, they're not going to pay you high enough for the business. If you can establish that they do not need you for the business and they can enjoy that consistent cash flow and let the business still run on autopilot, that business has value. So the closer to get this. Now, you may not be able to get to it 100%, right? Nothing runs 100% on autopilot, right? Or no cash flow is 100% consistent, right? But the closer to get to it, 70%, 80%, 90%, the higher the value.
Awesome. I love that. I think that that is so important. And of course, as we work with our clients, that's exactly one of the things that we tear apart and try to figure out. Where in the business is it dependent on the owner, and how can we help solve that equation? Because if it is a business that is not transferable, it really takes a hit on valuation for sure. So of course, everybody who listens to our podcast on a regular basis knows that I always ask a bonus question. So here we go, and they always stay tuned for this question because this is sort of the fun side. Although we've already seen for an engineer appraiser, you've got a sense of humor, and I love that. So here's your bonus question. What personality trait has gotten you into the most trouble through the years?
Oh, I think outside the box, or some people might call me a kook. I believe into conspiracies and all that. So I am not afraid of thinking outside the box. And, and evidence of that is like my YouTube channel. Nobody in my business would ever think about creating a YouTube channel with a 10-foot pole. But I did it because I think people needed education. Most people in my business want to go for the big fish, for the private equity, for the venture capital. I have worked for those people. I have worked with people who make $10 million a year. Now I'm going for the little guys. Now I'm going for the businessmen whose revenue is less than $5 million because there are so many of them.
Right. Yeah, that's, look, of what I call small business, 100 million in revenue and below, that's 99.7% of all businesses that employ people. And so that's like almost 6 million of them, or a little over 6 million of them in the United States. And so you're right, that is where most of the folks are. So, and by the way, I do love your YouTube channel. And so tell us where that is and how our viewers and listeners can get in touch with you, Bharat.
So there'll be a link to my YouTube channel in the description below, or you could go to YouTube and type in "What's It Worth," and my channel will pop up. And in each episode, we're trying to educate owners on different types of businesses, so a medical practice, a CPA practice, an auto repair shop, a winery, what have you.
I am a huge fan of the one on wineries. So I did enjoy that a lot because our listeners know that I was in the wine space for some time. So thank you for being our guest today. I really appreciate you taking the time to kind of lift the veil, so to speak, on how to value a business. Thanks for being with us.
Thanks for having me, Tom. Great chatting.
You can find Bharat Kanodia at Veristrat.com or on his YouTube channel, which is What's It Worth? Or you can find him on LinkedIn. And of course, you can always reach out to me and I will be happy to make a warm introduction. I can already tell, even though Bharat and I have only known one another for a short time, that we're going to become fast friends very quickly. This is the Maximize Business Value podcast, where we give practical advice to business owners on how to build long-term sustainable value in your business. Be sure to tune in each week and subscribe or follow us wherever you found this. And be sure to comment. We love comments and we respond to all of them. So until next time, I'm Tom Bronson, reminding you to make sure you really understand the value of your business while you work to maximize business value.
Thank you for tuning into the Maximize Business Value podcast with Tom Bronson. This podcast is brought to you by Mastery Partners, where our mission is to equip business owners to maximize business value so they can transition on their terms. Learn more on how to build long-term sustainable business value and get free value-building tools by visiting our website, www.masterypartners.com. That's master with a Y, masterypartners.com. Check it out.
That was perfect. I wouldn't make any changes on that.